Well, for more on the markets, let's head now to the TSX. We've got Diana Avigdor standing by. She's a portfolio manager and head of trading at Barometer Capital Management. Diana, good to be with you. Thank you.
Thanks for having me.
Let's talk a little bit about this. You do say that the extreme market pessimism is unwarranted. I don't know if it's extreme today. It doesn't feel like it. But what's your view on the pessimism in the market?
I do feel that there is extreme pessimism on the U.S. market, and there is extreme pessimism on China. And there is extreme pessimism on the bond market, and we're seeing a lot of volatility. So I'm not surprised. I think we continue to see the volatility, which does chip away at confidence. And after so many years of positive markets, a lot of people are expecting and would like to see a little bit of a correction. And I think that we're going into this volatility ahead of a Fed rate increase, which I'm a little sorry we didn't see one, because it just drags the volatility on.
But what do you recommend doing? You and your team run people's monies, individual money. What are you doing in this environment?
We think we stay invested. We think we stay invested in the strength sectors. We've been saying this for a long time. Stay invested despite the volatility. We do have accounts that are at 20% cash, and we will hedge through futures or other kind of hedging instruments as we see fit, but frankly only to subside the volatility of the portfolios, not so much because we think we're in a bear market category. Bear markets do not generally happen without a recession, and we don't see a recession in the works right now. Housing in the U.S. is fine. Leverage is not high. Employment situation is fine. We think the zero rate policy that is continuing in the U.S. is actually negative. And you know, on BNN, you guys have been talking in the past about the velocity of money. Well, zero rate policy does trap capital, and I think that the initial normalization of rates will probably trigger some of the things that we've been watching for that have not been happening, say inflation or more consumption or more investment. So money is sitting on the sidelines as long as rates are at zero. Not much gets investment, and a quarter point will trigger. Okay, let me take that loan. Okay, let me buy that house. Okay, let me buy that fridge.
But Diana, I just want to push back for a second, because some people would say that these lower rates and the fear of higher rates has done exactly that. That's actually triggered people investing now versus waiting. There's been this pull forward effect. You don't buy into that?
I do. I mean, from the perspective that you're saying that where else are you going to put your money if not in the equity markets, that's correct. That has been part of it. But that is going to continue. And as soon, when you have normalization, you know, it's great that money has flown into the stock market and stock markets have gone up because there's no other place for money to be. But when things are normalizing and there's normalized growth and companies make money and consumers can spend, that is also a good situation for stocks, and for better reasons.
Right. And that's important. Better reasons. Good news being good news versus bad news being
as
good
opposed
news.
to no choice, let's say, right?
But Diana, so you say you stayed fully invested. You really only hedged to kind of protect positions, not
no,
because you think
we did raise some cash. There are some accounts that are 20% cash.
So where do you want to invest? Where are you looking?
We are looking still. We have not really rotated in and out of sectors very much lately. You hear us come and talk about the U.S. financials. You hear us come and talk about the consumer discretionary. We continue that. The staples, we continue that. The healthcare. And you know, healthcare is topical today.
Yeah.
They're not doing very well, right?
Right. They're down 2 to 5%. Yeah.
That's right. That's right. So we're also trading elections. And the subject of today's sell-off is valid. And things normalizing and being right and being fair are good for markets.
Right.
There are other things that are working for the drug sector, for the healthcare sector. M&A, pipeline are fantastic. Some new developments in the whole industry as it relates to oncology and so forth. Biotech. I mean, there's some great stories. Today's story that triggered the sell-off, which you mentioned before I came on, those are all valid stuff, and the sector has a a volatile temperament, and it has done very well.
And a lot of people own it, Diana. That's the other issue. When you take a look at healthcare, a lot of people own these healthcare names,
Yep.
and so people are selling maybe and asking questions later. They don't know what the new president will do in terms of drug pricing. That's number one. And then the other issue, though, the other sector that seems to be over-owned or that was well bought was housing. Lennar comes out. People don't like their results. You've got existing home sales that are a little bit weaker than people wanted as well. I mean, these are two areas that people really bought into.
Right, but you know, this is where therein lies the opportunity, because the housing sales were weaker than expected, but they were not weak. And Lennar's numbers were decent.
Yeah.
They weren't bad, and traded up 4% pre-open. So this is where the opportunities lie. If you can mix and learn and see what you really believe in, take the occasional weakness that results from flows or no volume or headlines, because you know the volatility. This is a fact. The volatility in the market is much higher than we're used to. So therein lies the opportunities.
All right, we'll leave it on that note. Diana, good to see you. Thank you so much.
Thank you very much.
Thank you.